The market is open. Applied Digital, ticker APLD, is trading live right now at $33.12, and it is having a rough start to the day. It's down about $1.81, a drop of over 5.1% just minutes after the opening bell. The morning's trading has been a tight but volatile range between $32.75 and $33.68 on what looks like relatively light opening volume of about 440,000 shares. Now, seeing that 5% drop, most people who've had this on their watch list will probably sigh and say, "That's APLD for you," lumping it in with the general volatility of the crypto mining space it originally came from. That is the expectation. But here is the reality, and it's what makes this company so fascinating. APLD is not a crypto miner anymore. Not really. The company it was a year ago is almost unrecognizable from the one it is today, and the market is desperately trying to figure out how to value a company that has secured in writing an anticipated $11 billion in revenue from a single customer over the next 15 years, not to mention another massive $5 billion lease with a U.S. hyperscaler. The reality is the market is still trading this stock with the sentiment of a Bitcoin proxy, but its business model has transformed into a long-term, high-performance computing utility. This disconnect is the entire story. Let's start with the common ground, which is the stock chart. It is, to put it mildly, absolutely wild. This is not a stock for a set-it-and-forget-it account like you might use with Schwab Intelligent Portfolios. This is a stock for active traders, the kind of name you see lighting up the most volatile screeners on your Fidelity or Robinhood app. The 52-week range tells you everything you need to know, a low of $3.31 and a high of $40.20. That is not a typo. It's a more than 10x return from the bottom, and it has attracted a stunning amount of attention. The average trading volume is not 400,000 shares. It's nearly 30 million shares. This thing trades with a beta of over 6.7, meaning its volatility makes Tesla stock look like a sleepy utility bond. For many, that volatility is the expectation. They see APLD, they think Bitcoin, they trade the swings. But that's a critical misreading of the situation. The true story here is a fundamental, structural change in the business. Applied Digital, which wisely changed its name to Applied Blockchain, has pivoted hard. It's no longer just about providing hosting for crypto miners. It is now in the business of building and leasing out massive, specialized, liquid-cooled data centers for the high-performance computing, or HPC, industry. This is the picks and shovels play for the artificial intelligence boom, and it's happening at a scale that is hard to comprehend. The big tell should have been when NVIDIA stock was revealed as an institutional shareholder. Yes, that NVIDIA. When the company making the chips for the AI gold rush invests in the data center company, you should probably pay attention. The recent news flow confirms this isn't just a plan, it's an executed strategy. Just last month, the company reported its first quarter fiscal 2026 results. The headline numbers were a massive beat. Revenue came in at $64.2 million, crushing estimates of around $48.5 million. That's 84% growth year over year. And while it's still losing money on a GAAP basis, a net loss of $27.8 million, its adjusted loss per share was just $0.03, far better than the loss Wall Street was bracing for. But even this misses the point. The quarterly earnings are almost a distraction from the real announcements, which are all about the long-term contracts. Here is the core of the reality. Applied Digital has two massive projects in North Dakota. The first is Polaris Forge 1. The company has now confirmed this 400-megawatt campus is fully leased, primarily to its anchor tenant, the AI cloud provider CoreWeave. This isn't a maybe or a hopeful contract. This is a signed deal with anticipated contracted lease revenue of approximately $11 billion over the 15-year life of the agreement. Let that sink in. This is a company with a current market cap under $10 billion, and it has a single contract that will bring in $11 billion in revenue. That revenue is stable, predictable, and locked in for a decade and a half. This is not crypto mining. This is infrastructure. This is almost a utility. But they didn't stop there. Just a couple of weeks ago, APLD announced it had signed a $5 billion 15-year AI factory lease with an unnamed US-based investment-grade hyperscaler for its second campus, Polaris Forge 2. This is the validation. First, they proved they could build it and sign a massive deal with a major AI player, CoreWeave. Then, they immediately followed up by signing one of the big boys, the kind of company that has its own online investment platforms and cloud services, for their next project. This is how you build a long-term business. The expectation is that this is a high-risk, speculative stock. The reality is that it has methodically de-risked its future revenue stream to a degree that is almost unheard of for a company of this size. So why the disconnect? Why is the stock still down 5% today? Why does it swing 10% in a day? This is where the other side of the reality comes in, the risk. To build these massive, power-hungry, liquid-cooled data centers, you need one thing above all else: capital, a staggering amount of it. And this is where the bear case gets its teeth. To fund this build-out, Applied Digital has taken on a significant amount of debt and complex financing. As of the last report, we're talking about total debt of around $687 million against a cash position of $114 million. It's also been using preferred stock facilities, including a massive $5 billion preferred equity facility with Macquarie. This is high-stakes financing. The company's cost of revenue and administrative costs are also ballooning, up 144% and 165% respectively. They are in an all-out sprint to build as fast as they can, and that sprint is incredibly expensive. This is the tension that defines the stock. The bulls, who are likely doing their self-investing through an individual brokerage account where they can stomach the risk, see the $16 billion in contracted revenue over the next 15 years and see a path to $1 billion in annual net operating income. They see the backing from Macquarie and the investment from NVIDIA. They see a company that analysts like those at H.C. Wainwright believe is worth $40 a share. They are buying the reality of the future contracts. The bears, on the other hand, see the reality of the present balance sheet. They see $687 million in debt. They see a company that is still burning cash. They see the rising costs and the immense execution risk. What if there are construction delays? What if the cost of capital, thanks to macro pressures, goes even higher? What if competitors, like other pivoting crypto miners like Hive or Riot, or even established giants like Equinix, manage to build faster or cheaper? Many traders on platforms like Interactive Brokers are likely shorting this stock, betting that the debt load will crush the company before those long-term contracts can ever lead to real profit. This is a classic growth versus value story, but on hyperspeed. It's a technology infrastructure play that is being traded like a biotech stock. You can see this in the institutional ownership. On one hand, you have 504 institutions, including giants like BlackRock and Vanguard, who own over 63% of the company. On the other hand, you have fascinating moves like CoreWeave, the main customer, apparently exiting its passive 13G investment. That's an interesting wrinkle. But then you have the company's own management who, in a very bullish move, recently amended its Series G preferred stock to raise the minimum conversion price from $22 to $34. That's a sign of confidence. They are telling their own financial backers that the stock is worth more, and they don't want them converting and selling shares at a cheap price. So where does that leave the person looking at the stock, maybe on a platform like SoFi Invest? It leaves you with a deeply polarized story. The future outlook is a tale of two extremes. Comment below with your thoughts on this, as this is the central question for the company. Is APLB's massive $687 million in debt a necessary cost of growth to secure $16 billion in revenue? Or is it an unmanageable risk that makes the stock uninvestable? In one scenario, the company executes. The Polaris Forge 1 and Forge 2 campuses come online on time and on budget. The revenue from CoreWeave and the mystery hyperscaler starts flowing in, turning into a predictable, massive stream of cash flow. The company then uses that cash flow to pay down its debt, and the market is forced to re-rate the stock not as a speculative miner with a 6.7 beta, but as a stable, high-growth AI infrastructure provider. In this scenario, the stock doesn't just revisit its $40 high, it blows past it. It becomes a core holding, not unlike Apple stock or Nvidia stock for the AI-powered future. In the second scenario, the execution fails. Inflation and supply chain issues cause construction costs to spiral. Interest rates stay high, making that $687 million in debt an anchor